In this video, we're going to cover the business of investment banking. First question we should ask ourselves is, what is an investment bank? And it's good to think of investment banks as opposed to commercial banks. Commercial banks accept deposits, whereas investment banks are those that deal mainly with corporate advisory services and underwriting offerings for financial institutions. The two different types of banks were created from a U.S. law from 1933, the Glass-Steagall Act, which made banks choose whether they want to be commercial and accept deposits or be investment banks and deal with advisory services. That's the act that gave us the split between J.P. Morgan, which moved towards, at the time, commercial banking, and its affiliate entity, Morgan Stanley, which moved into investment banking. The lines have actually blurred quite recently with the 1999 repeal of the act, which has led to numerous mergers and acquisitions in the banking industry. A great recent example is Bank of America, a traditional commercial bank that accepts deposits, has ATMs, acquiring or merging with Merrill Lynch, one of the top investment banks of the last few decades. Today's top investment banks include Bank of America Merrill Lynch, who's the top in the loan business, Goldman Sachs, who tops the M&A business, J.P. Morgan, who tops the charts in equity and bond issuances, and other banks including Morgan Stanley and Citigroup, whereas the top foreign banks include Credit Suisse and Deutsche Bank. There's also a whole bundle of other banks that specialize in other services, such as Lazard, which is a restructuring and M&A leader, Jefferies, Evercore, Hambrecht, which sprung up to specialize in IPOs out on the West Coast. Structure within banks basically has two forms. There's the product groups and the industry groups. Product group bankers focus on a specific product for their clients, such as mergers and acquisitions or M&A, restructuring. They focus on knowing everything they can about the capital markets from the equity side, the debt side, whereas industry group bankers focus on a specific industry and try to get to know all the players, the trends. Examples in the industry groups include telecom groups, media groups, consumer groups, healthcare, and groups called FIG, or the financial institution groups. Within an investment bank, the general hierarchy of employees goes from managing director, a person who heads a group, and then the titles move on down to vice president, to associate, to analyst. And as you might expect, the pay also moves down from managing director as well. Analysts tend to be hired right out of undergraduate programs, whereas associates are either promoted from the analyst pool or are hired right out of MBA programs. And many bankers who move on from banking go on to roles in private equity, venture capital, hedge funds, or even management roles within operating companies, such as a CFO role or even a CEO role. Next, going to talk about the types of transactions that investment bankers advise upon. One of the biggest groups is called mergers and acquisitions, or M&A. And within that, bankers can advise either on the buy side or the sell side. And as you might guess, buy side means working for clients who are buying companies, and sell side works for clients whose company is for sale, or division of a company is for sale. M&A bankers might also do fairness opinions, which is something, an engagement whereby they're hired by a board of directors to ensure that the shareholders are getting a fair price. Usually a fair price is being paid for a company. Could also be on the other side, that they're not overpaying. M&A bankers sometimes get hired by boards of directors to do evaluation of alternatives. That often leads to a sale of a company. It's often stating that a company's share price may be undervaluing the company. M&A bankers can also advise on joint ventures and takeover defenses. Time now to talk about a couple of the categories of buyers that M&A advisors deal with. Strategic buyers are operating companies that make acquisitions to improve their business, to add on to their business. An example might be, think of IBM buying a software company. IBM can roll that into its suite of products that it's going to offer to its customers. The other main type of buyer is called financial buyers. These are non-operating companies, things like hedge funds and private equity shops that acquire businesses in order to earn returns on their funds for investors. And they often seek to improve upon operations, and then that early M&A deal then often leads to some sort of liquidation event for the investment at a later date. That could be an IPO or a sale of a company. A recent example of this is Carlyle Group, one of the biggest private equity firms, buying Dunkin' Donuts and attempting to take it public as I speak. Another major transaction group that investment bankers deal with is equity offerings. So this is assisting companies in issuing basically stock. That can include a whole number of things, including the famous kind of the IPO market, but also secondary offerings for public companies, as well as private placements of stock, basically finding buyers for non-publicly traded stock, or even privately finding buyers for big slugs of public company stock where they don't want to sell it on the open market. Debt offerings, another major basket of transactions handled by investment bankers, included assisting companies by issuing debt. So that can include bonds, both investment grade, top-notch companies such as General Electric can issue investment grade debt. Companies who have to offer a bit higher interest rate is called it's called high yield market. But the investment bankers will also advise upon other levels within a capital structure, such as mezzanine debt or convertible debt. Last basket I'm going to touch upon here is just restructuring. That's advisory services for distressed companies. Often includes renegotiating the terms of debt or even getting companies out of debt by doing a debt for equity swap, advising on the bankruptcy process, and even selling companies in a distressed situation. Last topic to touch upon in this video module is just the process by which banks get hired, the pitch book. A significant amount of time spent by junior bankers is spent preparing pitch books. They're presentations made by bankers to clients in order to win the business. They tend to follow the following rough outline. Basically includes an overview of the bank with its departments, its organizations, whether it has global reach or just national reach. Often what's called league tables, basically charts showing the rankings of banks, and banks will try to find ways to show themselves at the top of a chart, whether it's by size of deals or geography or timing. And some of the banks that are just at the way top can just show the tables kind of straightforward. Pitch books will also include what's called tombstones, which is information on specific deals completed by the bank. Most often the bankers will try to point to some relevant deals, either in terms of industry. In the case of Makeup Co, they may say, hey, we've done other deals for cosmetics companies, personal care companies, or we've dealt with other high growth companies that are involved in retail, or we've had experience selling companies to financial buyers, selling companies to overseas buyers. The overview of the bank will also include some short biography information on the deal team, often kind of deals done in the past, education. Next section would be a market overview, which might be contributed by, as we mentioned before, the equity cap markets group or the debt cap markets group, just saying, hey, here's the trends in the overall market. These are things that may help a sale or hurt a sale. Good debt conditions can lead to a high price being paid by financial buyers. And then looking at kind of some of the metrics within a specific industry, whether, in this case, the cosmetics industry, whether it's trending upwards, flattening out, or trending downwards. Pitch books will also include a valuation, which takes a significant amount of junior bankers' time. It's very relevant when pitching for M&A deals and for equity offerings, because you're saying to the client, hey, here's what we think your company is worth, here's what we might be able to get for you out in the market. And the valuation that we're going to go into in much more detail in future modules is usually composed of comparable companies analysis, precedent transactions analysis, and a discounted cash flow or DCF analysis. Pitch book might also contain some recommendations or positioning. The bankers might profile some key players in the industry or key financial buyers. Might put together some sample financing strategies that financial buyers might consider. And in an IPO pitch, on an equity side pitch, bankers may discuss ways of positioning the company relative to other stocks. In our case, Makeup Co, being a cosmetics company, doesn't necessarily need to get lumped in with other cosmetics companies. It can be positioned as a specialty retailer, a high growth retailer, any way that the bankers might think to position it based on maybe the success of some other currently traded stocks. Pitch book might also include a process overview, just to let the operating company know, the potential clients know, the timeline for transactions, how things are going to work, when management might be needed to make presentations and to allocate some of their time to the deal. And lastly, book may touch on the fees that will be requested by the investment bank. They tend to be based on the value of the deal. IPO fees run around 6 or 7% of deal value. M&A fees can vary very greatly, but often hover around 1% for mid-level deals, with the fees getting much lower than 1% for much larger deals.